Hello and welcome back to The Note. Let's move away from short-term political machinations in Washington today and take a look at the truly long-term. Now, you might remember that early last year we talked to a guy from Goldman Sachs who had a glorious theory called the long goodbye. The idea was that stocks were due for a period of prolonged outperformance, and evidently so far it's worked very well. Well, we're now into a different stage of the cycle. Stocks are that much more expensive and we need to return to the argument, which is why he's now published a new research document called The Long Goodbye 2. He's Goldman Sachs Chief Global Equity Strategist, Peter Oppenheimer. Peter, thanks for joining me once more. Let's start by taking a look at your schematic view of the way a bull cycle typically moves. We've obviously had despair past us for a while, followed by hope. Where are we now?
Well, each of these bars are showing what tends to happen to prices in real terms, profits and valuation. So each phase of the cycle is driven by a different factor. Right. We have been, we think, in the last year in what we call the hope phase, where you get an explosive rise, almost entirely driven by multiple re-rating.
Yes, earnings have been flat while we've had this rally. Yeah.
And that's why it's anticipatory or hope. And that tends to be relatively short-lived, a little less than a year on average. And we think we're transitioning into this much longer period where returns may be lower, but they're driven by fundamental profit and dividend growth.
Okay, now let's take a look at the prospects for that. This is a chart, I should say, that specifically concerns Europe. Are we below trend in profitability in Europe? Is it reasonable to hope for a switch back?
Yes, of course, there's a question about what the trend actually is moving forwards, but profits are cyclically depressed. And we've also had a period of weakness in margins, at least in Europe, but not so particularly in the US. And we feel that as the global economy recovers, you will get a pickup in top-line sales, a bit of a rise in margins, and profits will begin to recover back towards their trend.
And now, is it fair to say that those are the kinds of arguments that have brought money at the margin from the States into Europe and European stocks over the last few months?
Yeah, I think there is some evidence that foreign investors, particularly those in the US, have raised their weightings in Europe from a very low base. And I think that's driven by, A, the fact that positive surprises in economic activity have come through in Europe over that period. Secondly, the valuations are cheaper. And thirdly, there's more of a cyclical potential for recovery in terms of profits and margins.
Because we're at a different point in the cycle in Europe than in the States. Now, one very interesting point you make is that valuations themselves, if we take a look at the next chart, valuations themselves can have an effect on corporate behaviour. Take me through this chart, which some people might find a little hard
very
at first.
simply, what we're showing here in the dark line is the equity risk premium, or the required rate of return.
Right.
The higher it is, the more uncertain people are, the higher prospective return that they require to invest.
And the cheaper
stocks are.
Right.
The red line is showing the proportion of cash to assets on company balance sheets. And the inference here is very simple, that in a period of sharply rising uncertainty as we've been in, not just investors but companies themselves have been hoarding cash, even though the return on that cash has fallen dramatically. That's been very good for bond investors, corporate bond markets, because the corporate balance sheets have been strong. As the risk premium begins to moderate, it suggests that companies use the cash more aggressively, either to give back to shareholders in buybacks or dividends, or in future investment growth or acquisitions.
Now, obviously this has been a matter of great controversy, that particularly people talk about Apple and the huge amount of cash that they had on their balance sheet at one point. Does it matter? We've had great excitement about dividends for a while. People seem to be less concerned about income at the moment. How much does it matter how companies deploy that cash? How do you expect them to deploy that cash?
Well, so far we have seen large cash piles being used more aggressively in the last several months, particularly in the US, where we've seen a boom in share buybacks as companies basically arbitrage the high cost of equity for the low cost of debt. We've also started to see dividends beginning to recover from a very weak base outside of the US, and they've already recovered quite a lot in the US. The M&A and investment side of the equation has been more moderate, and I think that's perhaps the next leg we might expect to see in the next year or so.
Is it fair to suggest that if we do see capex, extra capital investment, that would be the clear sign that we are now in the growth stage of the cycle, that this bull market has legs?
Yes, because I think it reflects two things. Firstly, you need confidence to invest in future growth. And secondly, to the extent that companies feel confident in investing for growth, that should lengthen the horizons of investors as they look more into the future of long-term potential cash flows and re-rate those relative to the very short time horizons that they've been focused on in the last several years.
Okay, Peter, thank you very much indeed.
Thank you.
The conclusion, I suppose, is clear. I tend sometimes not to be as bullish as other people, but the bull case is very reasonably made. Providing growth comes through, there is every reason to expect the stock market to recover and certainly to outperform bonds. The critical thing, of course, is that growth comes through.